All right, let's get started. Good morning, everyone, and welcome to today's conversation from the Edge. Today, we're joined by our Chief Business Development Officer, Kelly Mathieson, Barnaby Nelson, Chief Executive Officer at the ValueExchange, and Richard Walker, Partner at Bain. Welcome, and thank you all for taking the time to join us. Now, before we get started, I'd like to introduce you to our Conversations from the Edge series, where we work to promote knowledge sharing and thought leadership through targeted discussions. These fireside chats will feature key leaders and influencers in our digital ecosystem, where we get a chance to hear their timely and detailed insights on the innovation that is driving the industry transformation. Now, for today's discussion, we turn to our two industry veterans to share their perspective on the current position of digital asset creation and issuance. What is driving organizations across the market to launch solutions, and what will come next? And we'll leave some time at the end for audience Q&A. And as a reminder, this webinar is recorded and it will be shared with all of you after the event. I'd like to turn it over to Kelly to kick off our discussion this morning.
Great. Thank you so much. And thank you everyone for joining today. Very nice to have you here for the conversation. I'm actually thrilled to be kicking off this series, even more so to do it with two friends of our organization and two leaders in their industry, Richard and Barney, and delighted that they are our inaugural speakers for this series. What we're going to focus on today is asset tokenization and some of the activities that are arising in the industry as a result of the number of new digital issuances and tokenized versions of traditional securities that are being created. After all, asset creation and issuance is the first link in the post-trade value chain. And as markets have evolved from the shift from physical to digital representation, I'm sorry for the phone, physical to digital representation, and enabled, say, the dematerialization and the mobilization of assets. The fact is, though, that the post-trade area of securities processes and handling those new issuances has remained a bit firmly in the past. We've even seen introductions like wet signatures being heralded as big changes in the industry. And I think as many organizations who are going through now the move to T+1 are realizing there's still faxes out there as well. So it hasn't quite as advanced as much. But yet tokenization and digitization are revolutionizing the process of post-trade from end to end, both for traditional securities and for the creation of new asset types and asset classes entirely in a digital format. Across the market, we're seeing more come into this space, from Goldman Sachs's digital asset platform to HSBC Orion in the tokenized bond space, SGX in tokenized equities, Versana and syndicated loans, Equilend in securities lending, and more. The market is beginning to fill with examples of asset creation and the digital networks on which they operate. And so we'll spend a bit time availing ourselves of the expertise of both Barney and Richard to understand where the market is going and some unique insights that we could all consider in our own businesses. So Barney, just to set this up or set the stage for us with some of the grounding drivers that are causing market participants across roles, different participant types, to engage. With a large number of bond tokenization initiatives we see, maybe let's start and use that as an example. What's the biggest benefit?
Yeah, no, look, thank you, Kelly, and thanks very much for having me on the inaugural session, as you said. I think for me, you know, if you look at basically where we kind of come from, you know, what stands out for me is you've got basically around, our count is about 14 different asset classes have been tokenized in terms of actually issued in token form. You've got, you know, well over kind of 30 different issuances have happened, totaling kind of over $1 billion now of issuance. So this is kind of starting to, I think we're pretty much at the end of the beginning in terms of our collective experience in the issuance space. And I think for me, what really stands out is it's basically, it's a kind of shift from where we began was an operational play, ultimately trying to do things a little bit better, trying to manage the deal a bit better, all that kind of stuff. And what's really shifted very tangibly in the last, I'd say probably year is balance sheet. It's kind of, at the end of the day, operational efficiencies. If you look at what's happened with the IB, what's happened with, as you said, HSBC, with Goldman's issuances, so on and so forth, is that those operational efficiencies facilitate and unlock vast balance sheet savings. So why do you issue a digital asset now? It's really about essentially moving a T7 or T5 book closing period to a T1, T0 book closing period, saving a week of capital for a bond. And all of the RWA that goes with DVP transactions, those kind of balance sheet changes are vast and impact not just issuers and banks, but also investors.
Yeah, it's interesting. I think for the operating processes that we're all been part of, you would have thought of post-trade and these processes as being just consumers of balance sheet because of operating processes and inefficiencies. It's probably a bit of a pleasant surprise for some of these organizations to see the balance sheet impact the way you've described it, even more than the operating benefit. But Richard, can we also set the stage via you? Another area of, we say tokenization and we've been focused on bonds, but another area of considerable current focus are private assets and the private markets. We've seen a number of organizations from major market tech to governments on behalf of their small and medium-sized entities entering the space. Why is this happening?
It's happening because it allows access to something which is hard to access, highly illiquid, relatively opaque, but provides outsized market returns compared to public assets. Barnaby spoke to the 14 different asset classes that have been tokenized. From our work, the markets are relatively efficient, efficient enough, certainly, for access to myriad asset types. It is highly inefficient, high friction, high cost for access to private assets, private infrastructure, equity in private companies, private debt, private real estate, and yet there's high demand for access and exposure, for diversification, and for outsized returns by high net worth and private banking clients. So we really see, if we think about the build out of the tokenized infrastructure and financial markets on a blockchain architecture, we view the demand for access to these private assets as the catalyst for investment and to enable something that is not easily done today. And for that reason, we think that's going to fund the continued build out of the new infrastructure and architecture that we're all working in.
I would think too that the part of what you're referring to, for some, if you think about sort of the governments or market infrastructure entities of some countries, some organizations where small, medium-sized enterprises wouldn't otherwise have efficient access, it's probably what you're describing is an even more exponential or compounded impact for them.
Yes, certainly. They're within the context of, let's say, an ESG, umbrella, where social and governance, where the small companies don't have access to the capital raising that large companies do.
Right.
Small investors don't have access to outsized market returns of private investments the way that ultra high net worth investors do. It drives, and the overused term in our space of democratization, but it does bring down for small and medium-sized companies and for small investors access to capital and access to returns that heretofore have been enjoyed only by the largest and wealthiest players.
Oh, interesting. So if I switch back to you, Barney, for a second, or for a few minutes. So at the core of what both you and Richard have said as the grounding points suggests the obvious, the product innovation is at the core. And that sounds a little bit plain vanilla, but there are some very real business benefits with the creation of these new forms of assets to which both you and Richard have been referring. Now, that sounds good, but often this necessitates equal changes in the product development and operating processes. You don't create new forms of assets with old forms of technology and operating models. Can you share some, or maybe you do, but can you share some thoughts on that?
Yeah, I think for me, if you look at basically what's so as we said, we've kind of, if you think about the baseline of operational efficiencies and balance sheet, that's all kind of there. And I think as Richard, as you say, increasing the access is huge. But I think one of the areas that doesn't get a lot of attention is the actual the flexibility that affords you in your product design, that basically that a digital infrastructure can afford you, and that includes things like obviously agility on pricing. So the ability to price right up to the last minute. If you think about structured products, for example, what Clearstream are doing, that really means if you're doing kind of, I mean, their brilliant line of T+1 hour kind of issuance, if you're really moving things really quickly, then obviously your ability to adjust to market conditions, and therefore in your pricing and in the structure of your issuance is a big plus. So therefore everyone wins, because basically our pricing is better. But I think also there's other areas that are really kind of quite cool. We'll come on to the kind of shareholder governance piece, but I think for me, the standout example has always been in Thailand, where basically a movie was being financed by a bond, and ultimately you can just wrap in free movie tickets for anyone that holds the bond for more than 3 months. So I think you've kind of got this ability to price in favor of the investor, to price in favor of good behaviors, and I think for me that's a whole new opportunity that's just obviously not been possible before.
Now we're going to have everybody running out to buy digital bonds because they go to the movies. Well, that's a good example, right? Good. So Richard, if we could, I want to just build a little bit on the points that you've both made and focus. If we could, let's go back and focus more specifically a bit on the private alts market, because I just think it's an interesting and emerging space with this interesting and emerging technology and way of bringing issuances to market. And while I think much can be said about the benefits that Barney just shared applying to this market as well, you touched on it a moment ago on thinking about the managers, the investment managers, and the investors, and that they're more likely, while all of this is interesting, is particularly for us at DA to talk about the technology, they're focused on the return and on the access to a broader range of investments and an ability to reach more types of investors. Can we take that in two parts? Can you first just give a little bit more comments more fully on what matters most to the managers in the market as these new types of assets or new ways of handling these assets become possible?
What matters is a ramp to growth. How do you bring new capital into the private space? Right now, institutional wealth and individual wealth, that just assets, it's about 50-50 globally. So the wealth held by individuals is the same as wealth held by institutions, yet institutions hold about 85% of private assets. Individuals, even though they have half of the assets, only have 15% exposure to that asset class. So as managers want to grow the assets under management, there's not a lot of growth potential on the institutional side where they traditionally have operated. The largest wealth managers have put out specific numbers, but all wealth managers, of course, have an ambition to grow. And in order to fuel that growth, coming up with a mechanism to provision, AUM from the individual wealth bucket is increasingly important.
Does that mean like it's still, I mean, we could be talking about interesting new digital forms of assets and the tokenization of existing, but in the end, it's about getting the asset created so that managers have more tools by which to generate return and reach clients. It's sort of still the age-old asset management goal, right?
It is, yes, yeah. For sure. And there are a number of building blocks. So having a tokenization platform is one thing. So asset managers could tokenize funds or tokenize real estate, but the distribution, the liquidity, the asset servicing, right, the entire value chain, build for that, is being developed, right there for our clients who are working across each of the different service providers in the value chain to explore and develop, what is their role, what's their value proposition, how will they make money doing it, and how do they connect to this new ecosystem? So the asset managers, and a number of them have said this to us, that, great idea, love it, we want to do that. Can you connect us to wealth managers for distribution?
Yeah.
Are there custodians who can hold, for those clients and service those assets? So but we're confident, based on our work, that is being solutioned, that will be solved, that the demand on this side, and the wealth that is up for capture, and I'll talk about that a little later, is so compelling that it's going to catalyze the entire value chain to deliver against this proposition.
So it's a good point. Let's because you mentioned too about the ability to reach a broader range of investors as you are able to expand and or have the distribution be as equally digital or as networked as the assets itself. So we just talked about managers. What matters most to the investors then that are trying to get into this space of new asset types?
Based on our work, what matters to investors is the ease of access, the transparency, actually holding something. I mean, if you've ever done a subscription to a private fund, you get a document, you submit it. At some point, there's a capital call. There's a date. You have to, create the liquidity for that capital. You have to wire that. Sometimes you get a confirmation. If you want to use that investment as collateral for liquidity, it's very difficult because you're not holding anything like you would a stock, right, or some other asset. So the time frame, the liquidity, the functionality, the transparency, and just the overall cycle is relatively unattractive. It's not attractive to the advisors, because advisors don't want to put their clients in highly illiquid asset classes like that. So each of those design points are being addressed in the tokenization of private assets to make it more attractive. So and last thing, what is attractive to an investor is a lower minimum investment. So just everything from the investment to the onboarding process to the transparency, all of those things do matter. And while ultra high net worth and high net worth clients can allocate capital today, right? They're qualified investors, they're accredited, investors. They don't, because their advisors don't like the friction, and because they don't like the illiquid nature. So that's why there's at some wealth managers, less than 5% of their high net worth, ultra high net worth clients have exposure to these asset classes.
Oh, really? Wow. Okay. Yeah. Well, so that's actually those are some really good points. I hadn't actually realized the degree to which the market was narrow. I guess, sort of, no pun intended, there'll be private investments, but I wonder if the market will be as private going forward, given this, or given some of the benefits that you're talking about. But Barney, one aspect that is often mentioned when considering we go to the technology for a second, considering smart contracts and DLT and its ability to provide the impetus or the infrastructure to do what Richard is describing, to reach a broader range of markets. So we talked a little bit about managers, we've talked about the investors, but just thinking about the markets themselves and the types of products that come out from them, and a bit of trying to reach that, I want to say retail, but that broader set of investors who might otherwise just not have been attracted to this. Fractionalization is often cited as a key benefit. Could you just take a minute to explain to people what that is, from your experience, and why it's so compelling as a structure?
Yeah, no, sure. I can have a go. I mean, I think kind of depending on how far you go back. I mean, ultimately, I think for me, if you look at a lot of private securities and frankly, actually public securities in terms of bond issuances and things like that, that they are inherently big ticket items. To Richard's point about the kind of universe we're talking about, they're bigger than you or I would probably want to pay for in our wealth management account. I'm not making suppositions, but I think it's they're big dollars. And there are reasons for that. Ultimately, generally speaking, you've got obviously very, very high deal costs in terms of the actual cost of the transaction that needs to be borne by the issuer and obviously in the bank and therefore recouped, but also very high friction costs in the transaction. The reason why it's just very expensive for us to be able to subscribe to private equity or to a bond is because there are market structure reasons, but there's also significant cost reasons that prevent us from basically doing it at $1,000, for example. What's brilliant is that we've seen examples in Hong Kong and the Philippines and other markets where we're actually seeing basically these very big ticket issuances being broken down to $10 or $1, and basically in being able to actually really facilitate, Richard, as you meant, it's an overused term, but this democratization, but being able to actually get securities into the hands of the wider population, is a huge thing. And the way that that's achieved is ultimately by reducing all the costs that I just mentioned. So, the value of digitizing the issuance process is it's faster, it reduces the bank balance sheet costs of the paying agent. It gets the security out the door in a way that's, I think our estimations that it takes about 5 days to issue a private equity as opposed to about 90 odd today for a paper security. So you can get it out the door faster, but then equally, you don't have, with digital onboarding, you don't have the excessive friction costs of investor KYC, the transaction costs, you don't have multiple books. Hong Kong was a great example where you had 40 bank distributors distributing the Hong Kong government's recent bond issuance. There was no books reconciliation. So at the end of the day, the huge cost that would have gone on every day by 40 banks sending back their books to the bookkeeper to then send out the positions, none of that was happening. And so it's basically just by ripping the guts out of the cost base, amongst other things, that you get to the point where you can have a $1 transaction on a security, and the impact of that in terms of opening up liquidity is reasonably obvious, I think.
Yeah, ultimately, it's about making it, or the implied point in all the excellent insight you're giving is it's making it more accessible. And whether or not it's still, to some of the points Richard's making, it's right for the particular investor, whether it fits within the portfolio structure that a manager does, those things still remain. There's nothing about digital that's going to change that, but it makes it more accessible. And for both the investor looking for diversification and the opportunity for returns, and for a company looking to raise funds, it's a wider market, and that by definition should be a good thing.
Well, I think for me, it just becomes an option now. As you said, whether you take that option up or not is another thing, and that comes down to price discovery and other things. But for me, the main thing is in a world where basically people are looking for returns from the private space, and they, as Richard's been saying, is they get disqualified because of the fact that they're basically just highly illiquid, difficult to hold, hard to transfer. If we can bring down the barriers to that, then ultimately, obviously, that option becomes more appealing. Whether you then take it up, another matter. Right.
Okay, a couple more questions, and then I can see some good questions coming in from the audience that we'll want to get to. So, Richard, if we could just go back and bring it back full circle to some of the comments that you made at the beginning, and kind of sort of do a little bit of what's the punchline of it. So how will tokenization of alts, just to ask it directly, how will tokenization of the alts market affect the end-to-end of handling the process for those types of securities?
Thanks for the question, Kelly, because it gives me the opportunity to talk about, I spoke about how hard it is. Let's talk about how easy it will become.
Okay.
Let's talk about why it will happen. So it will become easier for this reason. There is $8 to $12 trillion in investor share of wallet available. That represents 8 to 12% of the total global public equities market.
Wow.
That's private capital that is on deck, ready to deploy in private alts based on our work and expressed interest by individuals. So with 8 to 12 trillion at stake, a lot can happen. And what will happen is asset managers will tokenize, whether it's funds or, direct shares in private companies, real estate, debt, other things. The tokenized version of that will become the subscription model. The onboarding as a qualified investor or accredited investor, will happen, will be streamlined through various distribution channels and wealth managers. It could even be through retail channels. The purchasing of a share of a fund unit in that private fund will be very easy and held. The capital call can occur through a smart contract and a credit facility to ease the capital call once you own that share and commit to the funding. The ability to then post that token as collateral for access, either for the capital call credit facility or for other credit during the life cycle of that investment. It's going to make it all so much more streamlined, transparent. The level of immediacy, the level of transparency, and for both the individual investor and the advisor, it ameliorates the preponderance of the issues that have kept both of those parties from going into private investments in the past.
Yeah,
$8 trillion will make that happen.
It is in the end of the day, right? It's the demands that's there. I actually hadn't realized how staggering that number was to sort of unlock that in a way that previously just would have been impossible or impractical, maybe is the better word on getting at it. Great. Barney, if we could go full circle with you as well. There's quite a lot of focus on our discussion topic today on asset issuance, the process, but the assets at their core, and we said this a little bit ago, are created to finance organizations. So you open it up by talking about the balance sheet benefit. What are some of the other impacts that will be gained by doing this sort of beyond the operating model?
Yeah, I mean, I think the one that really stands out for me is the whole shareholder engagement piece. I think it's if you look at where we're kind of going, basically the biggest frustration that we see from largely in the institutional space, but also in the private space, is the highly problematic mechanisms that exist today for an issuer of capital to be able to engage with the ultimate beneficial owner. So we've created a wonderful market structure that gives us netting, for example, through omnibus accounts, but that completely obfuscates our visibility from one end to the other of the spectrum. And so if you actually speak to issuers, that particularly in an age of ESG, with the G being governance, the pressures on institutional investors to engage and the pressures on companies to facilitate stewardship are just, shooting through the roof every day. And if you look at the problem that, that's creating, I mean, it's definitely past white noise, in terms of this is becoming an operational problem for people. How do you process more votes through the system? How do you solicit more votes through the system? How do you make sure they don't all come in 3 minutes before market deadline, that kind of thing? So you've got the operationalization of ESG at the moment. And then the second piece is just simply how can you reward good behavior? This is one of the things that obviously issuers, generally speaking, want people who are going to hold their securities for a longer time than a shorter time, et cetera, et cetera. The ability of using digital assets to reward good behavior is I think a massive upside. So you've got two big pieces of shareholder governance. One is just present day engagement, and second of all is just incentivization. I think those, for me, in terms of creating more appealing assets to more appealing audiences, and keeping up with regulatory pressures, I think we're going to kind of go from operational benefits to balance sheet to shareholder engagement as another big topic.
Yeah, it kind of completes the end to end in a really full cycle way. So, okay, I do have one last question for you guys, but before we do that, there's a couple of good questions from the audience that I will pose out. The first one is, Richard, to you, is a little bit definitional. Is this space what Bain refers, this domain, does Bain refer to that as Web3, or what is the term Web3 being used to govern? Is it all things digital, or is it some portion of it?
When we speak about Web3, we're speaking about the entire, tech stack to deliver, these solutions, whether it's the protocols, public-private blockchains, whether it is the smart contract programming languages like DAML, whether it is the wallets, either self or custodial type of wallet architecture. It's the assets themselves, whether tokenized assets, crypto assets, stable coins, NFTs for other things. So it's the fully elaborated stack of technology to build a new system for buying, holding, and leveraging value.
That's excellent. Thank you. And a question that I'll pose, paraphrasing a little bit to the both of you, and maybe make some comment on myself. So given frankly, the magnitude of some of what we're talking about here that is possible for transformation from as we've been talking about, the creation of the asset itself, through its life cycle, the ability to both improve the opportunities for investment managers to manage and investors to reach. Is it from a purely approach perspective, is this something that's a phased process for institutions to go through? I don't really think it's big bang. We've seen some examples of how that probably isn't going to work. But as you're advising your clients, is it, and I can comment on how we work, but you first, as you're advising your clients, how do you think about implementation? How do you get started doing that? Where do you focus on first? Richard, you want to go first and then Barney? Yeah, go ahead.
Sure. Actually, I'll take it first.
Okay.
Gradual, incremental, focus on new value, focus on revenue generation, not just cost efficiencies, because making the case based on incremental cost efficiency is very difficult when you're talking about like a new approach, a new process architecture, a new asset class, a new mechanism for expressing an existing asset class. We advise our clients to look for those places where you can drive something that can't be done today. Right? That's how you are going to garner investments. It doesn't need to be a big thing, but it does need to be something of value that's valuable to clients that they're willing to pay for. Start with that and then build reps in working in that space with this technology to basically transform the entire process architecture. But it can't be big bang, unfortunately. We're hindered by the paradigm of what we have that we have to manage while we build what will be.
That's right. I totally agree. But Barney, can you add your thought? You get to see a number of projects as well.
Yeah, I mean, I think for me, it's a really interesting point, because I think that we've gone down a few blind alleys on this one. That if I view it as kind of ultimately, because it's all about the investor, if you simplify it, you've got retail, wealth, family office, and then institutional as kind of four big money types, if you like. For me, the challenge is ultimately a lot of this stuff, if you look at where the adoption is today, is in private assets to retail. And actually, a lot of the people in that space are struggling to get numbers, just because of the fact that it's super hard to get millions of retail investors onto a single platform. So, for me, basically, and then at the other end of the scale, institutions, once you move into the regulated world, there are, still so many reasons in so many jurisdictions why, this is either impossible or highly problematic, depending on your compliance manager and so on and so forth. So I think those are work in progress. But for me, the sweet spot of this is, as we've been saying, is in the unregulated family office and hedge fund space, and then also in the intermediary space. So basically, it's really working with wealth managers and working on that specific kind of zone. And I say that because ultimately everyone has different product requirements. Everyone has different needs from what we're talking about. And I think for me, at the end of the day, a retail investor is going to do it mainly because it's fashionable at the moment. But ultimately, a family office will want better price discovery, not institutional level, but better price discovery, better tools, better visibility, and so on and so forth. So for me, it's about zoning in, building up, exactly as Richard said, building up reps, but by targeting that kind of just shy of regulated money, that zone, is basically what we need to be building around, because it's got enough money in it, and also basically it's got, it's obviously it's there's a good chance of success.
Yeah, very well said from both of you. I mean, I think in the end of the day, it's what you're both saying, or the underpinning of what you're both saying, it still has to be a very practical approach. I mean, we are largely focused on financial services here, although this certainly has as many applications to the financial aspects of other industries, supply chain, healthcare, the like, as well as other industries in general. And big complex institutions, systemically important institutions, or systemically structured market utilities are not organizations that you just sort of, change overnight and shift away from underlying technology. It's not sound and sort of prudent to do so. So these phased approaches that I think to both of your comments are just practical approaches. Just look for those projects that are going to improve operating efficiency, improve reaching clients, improve revenue generation, be measurable, be advised by whatever is the right advisory council. Is that your clients? Is that an internal working group? Are those regulators? Some combination of all. And have a constant, moderate, and measured pattern of being able to weave the technology, and that may be the way of thinking about it, to weave the technology into sort of the infrastructure of an organization rather than a rip and replace. Okay, one last question. And I'll put it out there because it's a good question, but you might want to just point the answer to where someone could get more information. But someone's asking, like, so in terms of being a startup organization that wants to create tokenized retail contracts or retail products, like where do they start? So we're not talking about a bigger institution, an enterprise, a large enterprise organization, or a government or a regulatory organization, much of sort of where the press is now, but it's sort of the day in, the day out. If you're a smaller organization looking for new product opportunities, while at the same time sort of balancing the need for investors and capitals, how would you advise they start thinking about tokenization in this space?
I mean, I would probably, if I may, I think there are enough platforms out there in the early stages just to go out and try one, actually. I think for me, I don't know if it's oversimplifying, but I think you have to start somewhere. And, at the end of the day, we've all had to spend however many years learning up on basically what this really means to each of our organizations. So for me, basically, not necessarily as a proof of concept, but as a small issuance of capital, I think there are enough platforms out there to just basically issue whatever it is, an NFT on one of your product lines or something like that, and just have a go. Because I think it universally, through all the DLT experience, it is always, it's always what you didn't know going in that really actually matters. So for me, it's basically just have a start. At the moment, it's super easy. It's not going to make you billions of dollars, but ultimately that competency building up is, it's like everything, you have to take your first steps. So personally, I think that's it. But then second of all, I think is, the ecosystem point. If you're going to make this work, it's because all of your investors are on board. All of your ecosystem that you live and operate in is on board. And if you can't bring the ecosystem with you in some meaningful way, then the whole thing's not going to really.
Or that you're joining one, right? That you're joining one.
Or plug into one. The challenge is I'm not sure how.
And just on that point, and then I'll go to the last question. This is not meant to be a sales pitch for DA, but we are hosting. So I will just simply say to the person who asked that question, check out Demo Hub. It's our software as a service platform where you can use our tools and our technology to enable solutions really in a matter of minutes. So I will stop the sales pitch right now and just say that it's something to check out. Richard, did you want to add a point on that?
The only thing I would add is content matters.
Yep.
The quality of what you bring. It's going from like a vinyl song to an MP3. If it wasn't a good song on vinyl, it's it doesn't have value through immediacy and digitization. So whether depending on what it is you want to tokenize, it needs to be something that is of high quality and value. That's all I'd say.
Very good advice from both of you. So, all right. So thank you so much. A quick last word. Now, realizing that you don't have a crystal ball, But you do have decades of experience. What's one change arising from the creation of digital ecosystems that you think will be most surprising? You get a last word.
You go first.
Who goes first? Barnaby.
Honestly, I personally, I just think it's the restructuring of the relationship between issuers and investors. I really think that basically we should and could get to a point where, within regulatory frameworks, we can totally have a bespoke relationship with different groups of investors and totally change the way that basically that we issue and maintain capital.
Capital is the oxygen for growth, for individuals and for companies. So I think that couple of things. I think that the bootstrapping of individuals as well as small companies to grow is going to be a big surprise. I think the challenge to the efficacy of the public markets because of the ease of access to capital through private markets is going to be a surprise. I think that through our work, again, we don't like to use, and I've used it twice now, the democratization, but the access. If you think about what crypto, taught us, I mean, look at all the people that hold crypto because it's easy, it's interesting, there's immediacy, there's something that you have. 28% of Blacks in America hold crypto, right? They're the most highly penetrated demographic. And once you begin to bring other assets, that have similar, properties for purchase, hold, and posting for, as collateral for various uses, it's just going to explode and bring, individuals and small businesses to a level of growth and opportunity that we've not previously seen. So that's what we view as some of the most surprising things yet to come. But if only I had a crystal ball to know whether that was true.
Well, I'll put my money behind you guys. I think you have excellent insight, and I'm really grateful on behalf of DA, but also on behalf of all of the people that took the time to listen today, that you shared such fantastic insights. And with that, we'll conclude. Bella, can I turn it back to you?
Yes, thank you everyone for joining our very first Conversations from the Edge. I hope you all have a great rest of your day, and thank you for joining.